Good morning. This is Larry McMillan with a stock market update on Tuesday, January 21st, the first trading day of this holiday shortened week. So S&P rallied on Friday, and really it's rallied 250 points in the last 5 days after it looked like it broke down below support. So the bulls are still very much, in charge of this market, at least for the short term. And S&P has now risen back above old resistance at 60.10 and probably has its eyes set on the all-time highs at 6,100. For now, it's still in a trading range between 6,100 on the top side and 58.30 to 58.70 on the bottom side. But we'll see. Since it's in that trading range, we're not carrying a core position at this time. The individual indicators are still mixed. Equity-only put-call ratios are rising, so that's bearish. There has been a heavy call buy in the last couple of days, but still, those are 21-day moving averages, so they're still rising. Breadth, on the other hand, has turned strongly positive, and both breadth oscillators are on buy signals in modestly overbought territory right now. New highs versus new lows is a neutral indicator, so one of each. The new highs have outnumbered new lows, but they haven't risen to at least 100 per day for 2 days. That's what would take for it to turn to a buy signal. The realized volatility is bearish. We have the 20-day historical volatility of SPX is still up at 18%. And also seasonally, this is typically a bearish time, at least for NASDAQ, starting today and continuing on through the rest of the week. The VIX last week did drop, although it didn't really close much below its 200-day moving average last week. Today it is below the moving average, so if it closes below its 200-day moving average for 2 days, that would clear out any sell signals that had existed from the trend of VIX. And the spike peak, VIX spike peak buy signal is still in place. That is in place for the rest of this week. So the only remaining thing is the construct of volatility derivatives. That's pretty much bullish for stocks too, although there's a little worry over next week's FOMC meeting. They're meeting on Tuesday and Wednesday. So overall, the indicators are mixed, and S&P is in a trading range. It's volatile within that trading range. As I said, we've risen 250 points in 5 days, leaving a couple of gaps on the chart. Usually those gaps are filled in pretty short order, so I wouldn't be surprised to see a pullback to fill those in. But right now the market's riding high on the inauguration, and we'll see if it can punch through 6,100 and go to new all-time highs. So I invite you to visit our website, take a look at those. Also, we just published an article on MSTY, one of those ETFs that does cover call writing against a volatile stock, MSTR being the stock. So that article is available for new subscribers on our website, and for old subscribers too, of course. But I invite you to take a look at that. That might be of interest to you as well. Meanwhile, have a great week trading.